The least interesting thing I can tell you about him is that he is one of the 100 or so richest people in the world.
Welcome to Watch Mojo, and today we're counting down our picks for the most famous investing fails of all time.
It's described as nothing short of breathtaking, a points drop never before seen on the US markets.
Number 10, Jesse Livermore. Despite being a trailblazer in the practice of stock trading, Jesse Livermore's story is ultimately one of tragedy. His greatest success came during the 1929 crash, where he aggressively shorted the market and amassed a staggering $100 million, an impressive amount even today, let alone for the time. But despite his brilliance, Livermore struggled with personal problems which severely affected his mental health. To make the situation even worse, the Securities Exchange Act of 1934 imposed new rules that ruined how Livermore operated. This included an increased regulation of short selling, which was Livermore's bread and butter. By 1934, he was bankrupt, having accrued debts of $2.5 million. He ultimately took his own life in 1940, writing in a note, "I am a failure." Number 9, George Soros.
He has been called everything from a revolutionary plutocrat to the one man with his own foreign policy and the means to implement it, to failed philosopher. That's his term for himself.
Known as the man who broke the Bank of England, Soros made $1 billion by shorting the British pound in 1992, a famous move known as the Black Wednesday trade. But he also suffered some extreme defeats. For example, he lost roughly $1 billion by betting against U.S. stocks after Donald Trump's election in 2016, having expected a market downturn.
The markets for the moment seem to be behind Donald Trump. It lost you a lot of money. What are they seeing?
The market went up, but perhaps more significantly, Soros lost billions when the dot-com bubble burst in early 2000. Like many, Soros had invested heavily in technology stocks, and when the bubble burst, so too did his empire. Well, okay, not really, but he did lose a significant amount of money and was forced to restructure his entire investment strategy.
So you have an initially self-reinforcing, but eventually unsustainable and self-defeating process. And that is more characteristic of financial markets than equilibrium.
Number 8, Bill Ackman.
He was deeply involved in this company when it ran into troubles. Was the fundamental problem really in their structure, that they would buy cheap drugs that had been around and just jack up the prices? Or was it a more fundamental issue within the company?
The founder of Pershing Square Capital Management, Bill Ackman, made a huge mistake by investing heavily in Valeant Pharmaceuticals. Ackman's company had purchased an 8.5% stake in the company, but it faced significant controversies in 2016.
The bottom line is companies should look after their bottom line, but they also have an obligation to protect lives. So when it is they are willy-nilly jacking up the price of drugs that can save lives, and what they're doing is risking destroying lives, then that's not about money.
There were famous accusations of drug price gouging, shady accounting practices, and even fraud, resulting in an investigation by the Securities and Exchange Commission. Its stock plummeted by as much as 90% in the wake of the controversy, and its name was changed to Bausch Health Companies. And while this was going on, Ackman jettisoned his entire stake in Valeant, accruing a loss of over $4 billion.
And so once the market lost confidence in management, the stock price got crushed and it impaired their ability to continue to acquire low costs, drugs. And we lost $4 billion.
$4 billion.
Yeah. How's that for a big loss?
Number 7, Carl Icahn.
We do have a bombshell today from short seller Hindenburg Research, which is revealing a new short position against Carl Icahn's IEP.
This billionaire investor made his fortune by taking control of struggling businesses, cutting costs, and pressuring management to improve efficiency in order to benefit shareholders. As such, he developed a reputation as a corporate raider, especially following the hostile takeover of Trans World Airlines in the 1980s.
So could we call this a battle of the activist times?
Yeah, you certainly could. In fact, this very negative report is entitled Icahn Enterprises, the corporate raider throwing stones from his own glass house.
However, his fortune partly collapsed in May 2023 when a firm called Hindenburg Research accused Icahn of overvaluing his assets and running a risky financial structure, like paying an unsustainable dividend to shareholders. The stock price of Icahn Enterprises dropped sharply following the scathing report, reducing Icahn's personal net worth by as much as $10 billion.
It was a huge hit also to Icahn's personal fortune, an estimated loss of about $10 billion. This after Hindenburg claimed that his company is overvalued.
Number 6, Isaac Newton. Yes, the Isaac Newton lost a fortune trading in stocks, and shortly before his death in 1727. The South Sea Company was a British trading business that had a monopoly on trade with South America in the early 18th century. This was the Nvidia of its day, being heavily promoted as a lucrative investment with a skyrocketing stock that had nowhere to go but up. Newton made thousands with the company, but the infamous South Sea bubble burst in 1720 after investors realized that the company couldn't justify its insane stock price. This was the stock market crash of its day, and thousands of investors, including Newton, were ruined. He ultimately lost around £20,000, which was a substantial sum at the time. Number 5, John Meriwether.
John Meriwether is best known, or rather notoriously known, for his hedge fund Long-Term Capital, which back in 1998 lost more than 90% of its assets.
This name and his company, Long-Term Capital Management, are infamous in financial circles. John Meriwether worked at Salomon Brothers until he founded LTCM in 1994. The hedge fund made a ton of money in a short amount of time thanks to heavy borrowing, complex modeling, and risky investments in government bonds. But the latter got them in trouble, with both Asia and Russia suffering a financial crisis in the late 1990s.
So here you had super bright, extremely experienced people operating with their own money. And in effect, on that day in September, they were broke.
The market went wild, investors stopped trusting in government bonds, and LTCM's losses spiraled to the tune of $4.6 billion. Their catastrophic failure nearly caused a financial collapse, and the Federal Reserve Bank of New York was forced to step in and bail them out.
The Fed was concerned that collapse that could have brought down the entire U.S. financial system. Then Fed Chairman Alan Greenspan worked fast to convince banks to stay invested in the fund, averting potential disaster.
Number 4, Michael J. Saylor.
It lost a quarter of its value in just 1 week.
Once this body started in motion, it was very, very difficult to put the brakes on. And by 1 o'clock, everyone threw in the towel and said it's a foregone conclusion. These things are going down.
One of the biggest victims of the dot-com bubble was Michael J. Saylor, co-founder and CEO of MicroStrategy. The company stock skyrocketed in the late 90s owing to great tech enthusiasm, and Saylor became a billionaire. But in March of 2000, MicroStrategy was forced to restate its financial results, and the company was accused of securities fraud. These events caused its inflated stock to collapse and helped to trigger the dot-com bubble burst.
Saw it, didn't you? It was down some.
Why? How come?
I don't know. Bad day.
Bad day for you?
Another one, yeah.
Yeah, I know.
Too many in a row.
Saylor lost about $6 billion in the fallout, and to make matters worse, fraud charges were later filed against the company by the Securities and Exchange Commission. Despite this, Saylor has remained in the financial business and is currently a prominent investor in Bitcoin.
MicroStrategy's bought about $8.3 billion worth of Bitcoin, and Bitcoin's up 44% a year on average since then. The S&P's up 12%. And since we levered it, we're up 825%.
Number 3, Ray Dalio.
You made all these mistakes and learned from them without going bankrupt, which is what happens to a lot of investors. Or did you go bankrupt a few times in that period and then come back?
No, but I had one crash, 1982.
This Harvard alumnus founded Bridgewater Associates in 1975, which is currently the largest hedge fund in the world. So you know he's doing something right, but that wasn't always the case. In the early 1980s, Dalio made a big bet predicting that the U.S. economy was going to crash.
And I figure we're going to have a hell of a debt crisis and the economy's going down. And that was the exact bottom in the stock market.
However, he couldn't have been more wrong. The economy boomed. Bridgewater nearly went bankrupt and Dalio lost everything. He had to let all of his employees go and was forced to run the company out of his small apartment while borrowing money from his dad to keep the lights on. But instead of giving up, Dalio learned from his very costly mistake and became one of the most successful investors in history.
I lost money for me. I lost money for my clients. I was so broke that I had to borrow $4,000 from my dad. This was very, very painful. But it turned out to be the best thing that ever happened to me.
Number 2, Bill Hwang.
One way to measure this fiasco is by adding up Bill Hwang's losses, $20 billion, to the $10 billion that the banks have lost. In total, you've got $30 billion wiped out in the space of a week.
In just 10 days, Bill Hwang lost over $30 billion. Let's back up. Hwang ran Archegos Capital Management and used a high-risk trading strategy called total return swaps to amass a fortune. Basically, he borrowed heavily from banks, made huge bets, and allowed the banks to hold the shares, keeping Archegos hidden from pesky regulators.
He was an outsized influence in financial markets, but almost nobody had ever heard his name, and nobody had ever heard the name of his firm, Archegos Capital Management.
Long story short, the stock sank, the banks panicked and liquidated positions, and Hwang's entire portfolio collapsed to the tune of $20 billion. The banks that lent money to Hwang also suffered losses as high as $10 billion. In April 2022, Hwang was charged with racketeering and fraud and sentenced to 18 years in prison.
Archegos Capital Management founder Bill Hwang was just sentenced to 18 years for fraud and market manipulation that led to his firm's collapse in 2021.
Before we continue, be sure to subscribe to our channel and ring the bell to get notified about our latest videos. You have the option to be notified for occasional videos or all of them. If you're on your phone, make sure you go into your settings and switch on notifications. Number 1, Masayoshi Son.
Everybody had written him off. You know, he'd lost billions on options trading, SoftBank Vision funds were underwater, sea of red ink. So I think they thought that I was going to sort of say he's a loser.
If you want a dramatic story about stock market woes, look no further than Japanese investor Masayoshi Son. Son and his SoftBank group were hit hard by the tech crash of 2022, with poor investments in failed startups like Katera and WeWork. As a result, SoftBank lost nearly $30 billion in valuation.
Two of the Vision Fund's biggest investments, Uber and WeWork, causing investors to wonder if Masa's Vision Fund is starting to show some cracks.
But that's nothing. In the late 1990s, Son had invested heavily in various internet companies, including Alibaba and Yahoo, sending the valuation of SoftBank into the stratosphere. And like many companies at the time, this valuation came crashing back down to earth when the bubble popped in 2000. In just one day, SoftBank lost 93% of its market value, and Son personally lost upwards of $70 billion.
At the bottom of the crash, I actually revived my spirits of the fighting, so actually it was good.
What was the most you ever lost in a gamble? Let us know in the comments below.
It's tough. You make mistakes. It happens.
Did you enjoy this video? Check out these other clips from WatchMojo, and be sure to subscribe and ring the bell to be notified about our latest videos.